Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 130th VideoCast, 120th podcast for the week ending Thursday, April 14th, 2022. Coming to you live from Tampa. We'll be back over the weekend, but we're going to keep this one shorter than normal, 45 minutes. Got to get back to the swim meets. So far, it's been an amazing trip. Quickly, the girls are racking up the medals, so that's positive. They racked up a bunch in Tampa, and they're picking up more as we speak, so that's exciting, and we're going to see that award ceremony shortly. Then we've got our little speed demon over here. We took a late afternoon after the market closed jet ski twirl. We got, let's see here. By the way, when we got out there, let her drive for a little while. She's got more of the speed bug than I do. She had the thing pinned at 51, and she likes to take hairpin turns, which I took the skids on one of those, but pretty exciting to see. Then we went to see we actually saw the Lightning on Sunday. We didn't get any pictures from that. That was a great game. Lightning won 5-0. Then we went to see the Rays on Monday night. And I was able to catch a foul ball for Mimi and Annabelle off a bounce, not straight away. We were kind of behind behind home plate a little bit, between home plate and the visitors' bench. They fouled over the net because we're behind the net. And then it bounced off the upper deck, bounced back down almost to the field, and I caught the big bounce. So that was exciting. Not something you get to do many times in one lifetime. So we did that. They got some screen time on the Jumbotron. This was not like the Bolts. The Rays got completely blown out, but it's a nice indoor stadium, and it was a good mix. And considering I'm a hockey fan, I didn't really mind watching the Rays get blown out. As long as the Lightning crushed them, and that's the story there. So let's get right down to it because we are shy on time today. Okay, here we are. Media, real quick, want to thank Bansari Kamdar for including me in her article. This was on the CPI print. You're seeing futures up because everyone came into the report expecting that inflation would be a lot higher than anticipated. What we're actually seeing is that core CPI came in slightly lower than expected, particularly on the month-to-month core CPI, and that's a good thing because you really saw yields blowing out ahead of this event. This is a very positive report for stocks, and particularly tech stocks, the long-duration equities, which have been left for dead as the 10-year spike. This may be short-term spike in yields, and it may be a great opportunity to get exposure to tech as it finally starts to get bid once again along with bonds. And I think that's going to be the case in coming weeks in fits and starts. Moving on to the quote of the week from Peter Lynch, my idea of a great business is one that has a shortage of competitors. That could also translate into first mover that has a moat around share. And we're going to talk a little bit about that in the context of China stocks and how they come out of these COVID shutdowns, and the big will get bigger. This was an interesting article from Dividend Growth Investor that I thought was really interesting. 99% of Warren Buffett's wealth came after age 56. As a matter of fact, if you look at age 44, he was only worth $19 million. And it shows the effect of compounding over time and how that snowball gets bigger and bigger, which was the name of the book written about him called Snowball. You may want to read that if you haven't yet. But it just goes to show you a steady pace. And for people that get shaken out with headlines and short-term noise and give up quality businesses to other people who are stronger hands at the wrong time, you don't get these type of results or anything close to them. But for those who know what quality is and do their homework, the compounding works to your effect if you have patience. And that's mind-boggling when you think he was only worth $19 million at my age, and what he's been able to do over the subsequent periods. And don't forget, he's given away half. So people always talk about Musk being the wealthiest man in the world. He probably is on paper, but Buffett created something like no one else. Okay, Goldman Sachs, investors unusually fearful ahead of earnings. So there's a lot of fear in the market. That's a good thing. We're going to talk about sentiment in this week's article. UPS upgrades tech to overweight. This came out yesterday. That's actually, I think, going to prove to be a very prescient call. Urges investors to focus on software and services. This is from Keith Parker. Software and services, I think my bent is towards value tech. We've talked about it in recent weeks. I think if you're doing software and services, they have to be cash flow generative companies. It can't be companies that were 30 times sales and now at 15 times sales. That's probably not going to work moving forward. So you have to be selective, and we're actually going to talk about that because pessimism is now at 2008 great financial crisis levels, which was a buy everything signal. We're at that same level of pessimism. It's not a buy everything signal in my view based on where we are, but there are pockets of the market and sectors and stocks that we've talked about, which we'll talk more about today, that are at generational buy opportunities in our opinion. Not advice. Go to hedgefundtips.com, click on terms, and do your own homework. So moving right along, air travel is going very, very strong. So long cheap pandemic travel, buckle up for sky high airfares, supply and demand, economics 101. JetBlue just got upgraded, not because someone likes the Spirit offer, because the price got too low. These are opportunities. EasyJet. Summer bookings above 2019 levels. This is great. There was a Ask Me Anything question a few weeks ago on this, and I said everything airlines. I like the higher quality U.S. ones, but EasyJet will, and all of them will be beneficiaries. And the derivative play, which we've been talking about, are the engine manufacturers, the servicers around the world, and some defense companies that overlap in both with the pickup in defense spending that's going to be persisting in the coming decade. Delta, same thing. Delta stock surges after narrower than expected loss, big revenue beat. The TSA numbers, obviously crushing 2020, but double last year. And you can't see now you can. 2.0 versus 2.3 pre-pandemic, 2.1 versus 2.4, 2.2 versus 2.4, 1.9 versus 2.0, 2.3 versus 2.5, 2.2 versus. So we're basically at 90%, and that's sans business travel, which is starting to come back. Moving right along, emerging market stocks with a host of tailwinds are poised to outperform U.S. equities. I couldn't agree more with this analysis. This is a chart from Bank of America Global Investment Strategy. And it shows that largest inflow into emerging market equities in 10 weeks was this week. And the other thing that's interesting about that is obviously, as we know, China is the biggest weight by far of the emerging markets indexes. This look shows the current price to book levels are near 20-year lows versus the US for emerging markets. That divergence usually gets resolved rather quickly, just as you saw from 2000 to 2005. And I think we're moving into a similar period. And that's that. Moving right along, Alibaba stock is getting hit by China's latest COVID outbreak. 4 reasons for optimism from Jack Denton over at Barron's. Number 1, okay. A team led by Mark Hafeel, Chief Investment Officer at UBS Global Wealth Management, cites policy support from Beijing as a key booster for Chinese equities. Chinese government said in March it would work to support the country's stock market and clear up a punishing regulatory environment, including uncertainties about Chinese companies listed in U.S. Top officials in the China State Council this week said they would use monetary policy tools and consider other measures to boost consumption. That should help Alibaba, which relies on consumer spending. We continue to expect one reserve requirement ratio cut together with a policy rate cut as soon as this month, with greater spending and tax and fee cuts on the fiscal side, said Hafeel's team in a report. Moreover, proactive capital management provides a key catalyst, said the team at UBS. Alibaba is among the leaders in increasing share buybacks, recently moving to institute one of the largest share repurchase programs in Chinese tech sector history. The company still has some $16 billion in stock to buy back. This is a direct mechanism to enhance shareholder returns and showcase management's beliefs that current valuations are attractive. History suggests that share buybacks could buoy sentiment for a few months, as they may offer an immediate boost to earnings and book value. On the nuts and bolts of the business, the company is in early innings of a fundamental turnaround for its consumer management revenue, a core source of profit. CMR refers to sales of services such as advertising to merchants on its platform. Despite the risks the company face, Alibaba stock is cheap in numerical terms. 12.5 times this year's expected earnings, 10% discount to peer. The whole sector remains beaten down in terms of valuations. At the current valuation, the market seems to have written off the value of Alibaba's key assets, i.e. the cloud, logistics, international, and local services, said Zhang. We believe the risk reward is substantially positively biased for long-term investors. We couldn't agree more. China starts approving video game licenses again. If you recall, 2018, this was the cause of their crash for the last regulatory crackdown. It was part of this regulatory crackdown. They've now relented, and they approved 45 game licenses this week. So it just shows that is the about face. Hong Kong stocks rebound from 4-week low on Tencent NetEase rally as China ends gaming freeze. This is a big deal. This was a key part of the crackdown. They got rid of that. Coronavirus, Shanghai declares 7,565 areas low risk, easing lockdowns in selected zones as symptomatic cases dip after 6 rounds of tests. So this is positive. The zero COVID has been a complete disaster because they have no immunity, but we are seeing that despite cases surging and doing similar to what we saw with Omicron in January, which eventually rolls over, they have no immunity, so it's hit them harder, but they are easing that up, and I think people are underestimating, because just as the market is panicking, the government is panicking, and they're pushing out monster stimulus during these shutdowns, which once these cities reopen, number one, we're going to see an abrupt rebound in the consumer and in the economy, number one. And number two, after you get your monster reflection in the stock market ahead of the China National Congress, I think next year they're going to have to deal with abrupt inflation. But for now, they're just trying to salvage everything ahead of the China National Congress, despite the shutdowns, and those are getting eased as we speak. China's securities watchdog renews call that firms buy back their own shares, asks major shareholders to support stock prices amid sluggish stock market. The regulator suggested it will also look at stock and bond issue plans favorably to help fund buybacks. So the regulator also basically, they're saying, issue as much debt as you want, buy back your own stocks. We need to boost this market before November for the China National Congress political transition. Regulator also wants Social Security funds, pension funds, trusts, insurance company, and wealth management institutions to increase investment in capital markets. So we're going to shut down cities and shut off the economy. You better buy the stocks or else. And in China, or else means something entirely different than it does in the democratic world. So Bilibili Douyu rise in U.S. as China ends video game freeze. We covered that. This is from China last night. The guy who runs the K-Web ETF, he noted this last night. Fairly quiet news front as Shanghai grapples with its COVID lockdown, with 1,189 new cases reported, which depressed sentiment. Mainland investors are getting a bit antsy about definitive policy response, which we know is coming after the close. The State Council released a statement, including Premier Li, that, quote, policy measures to promote consumption, end quote, should be deployed. Automobiles and household appliances should be, quote, encouraged, while, quote, supporting new energy vehicle consumption. Banks should be, quote, encouraged to lend to small, medium enterprises. The release mentions a, quote, reserve requirement ratio reduction, which would mean the PBOC cutting the number of deposits they hold on the books, which is freed up for lending. There's clearly an effort taking place to keep logistics and food supply going, despite the challenges with the shutdown, et cetera, et cetera, et cetera. So that's that. China steps up stimulus with infrastructure bond sales quota. Allowance for this year has been fully allocated to regions. Infrastructure key is boosting growth amid housing woes. China's government granted provinces their full allocation of special bonds to be used for infrastructure investment. It's a sign it's stepping up stimulus to boost an economy overshadowed by a worsening COVID outbreak. We will waste no time to match the newly granted quota with eligible projects, Deputy Finance Minister Zhu Hongkai said at briefing in Beijing on Tuesday. We will ensure that special bond proceeds will be used to drive up investment significantly. Guys, they are flooding the market with stimulus, and it's not being reflected because of these short-term shutdowns. Once this rolls over, like Omicron did, and the previous variants, whatever they were called, Delta, Omega, they'll come up with a new one, I'm sure, before the end of the year. Then this is just going to fly. So sure, you can dump it when things look bleak, like the Daily Journal did, which we're going to talk a little bit about that. Although it's not clear that they actually dumped their position. So we'll talk about two possibilities with that. China's goal in COVID zero pursuit shifts amid Omicron outbreak. Restrictions expected to ease once community spread is cut off, and we saw that. The CSI, China stocks storm back on bets of policy support and COVID shift, i.e. easing up on the zero COVID, and then the stimulus, which we discussed. Foreign purchases of Chinese stocks Tuesday were among the biggest of the year. You can see that here. So that's moving in the right direction. The stimulus is being taken seriously. This is from South China Morning Post. Zhu Lirong, Chief Investment Officer at Franklin Templeman Sealand Fund Management based in Shanghai, said policy easing has begun. He's still bullish on the outlook over the next 3 years. Investors are more bearish than last year. The correction seen in big names has been bigger than the index, he said in a phone interview. When investors are too bearish, it signals the market is bottoming out. We agree. China promises to cut reserve requirement ratio when needed to boost the economy. The policy moves to happen at the appropriate time. State Council. RRR reductions often made within days of such cabinet comments, so we could expect it as early as this week, if not early next week, which would be also constructive. You couple that with some type of lockdown easing, and you're off to the races. So this is put out last night, the Bank of America Global Fund Manager Survey. As you can see, global growth pessimism is the lowest ever, implying lower net equity allocation. It's the lowest since October and December of 2008, which was a generational buying opportunity. This is a survey of almost 300 managers this month, from April 1st through the 7th, with $833 billion under management. The expectation shifted a little bit now from last month, in that managers are now expecting 7.4 rate hikes in this tightening cycle, which would end in early 2023. Investors also expect lower CPI, similar to in November 2008 when growth expectations were low. So there are a lot of similarities, and there are pockets of the market that are trading at great financial crisis type lows, back to pandemic lows that we think are tremendous opportunities. And profit expectations, again, back to October 2008 levels, generational buying opportunity. Stagflation risks elevated. I think that's going to prove to be similar to 2011, which shares another comparison in that managers are the most overweight commodities since February of 2011, right at the same time they were expecting the stagflation. I think, number one, that was the point at which commodities peaked in that cycle and started to roll over. And number two, so did expectations around stagflation. The tightening cycle is expected to conclude first half of 2023, which we covered. Global growth optimism at all-time lows, we covered. This is just a different measure in terms of expecting stronger economy versus global profit expectations. And the positioning, this is probably of critical importance. We're seeing a mass rush into cash and commodities and a complete exodus from bonds, which we'll talk about, and we started to talk about last week. This is the table that showed the highest overweight of commodities since February 2011. As we get into the article of the week, we'll address that. Most crowded trades are now long oil and commodities and short U.S. Treasuries. There's also a short China coming on. We want to take the other side of that. So basically what they're doing is they're buying what's already up and they're selling what's already down, right near the inflections. Opinion follows trend. Biggest risk, 26% global recession, hawkish central banks, and that's the survey. Now moving on to the article of the week, peak everything stock market and sentiment results. The theme of this week is peak everything: peak inflation, peak yields, peak commodities, possibly peak margins, peak growth, peak cash, and most importantly, peak pessimism. After Tuesday's core CPI number came in below expectations, consensus started to come around to the idea that inflation may finally be peaking. Here's the number. It's expected to come in at 0.5% month on month. It came in at 0.3%. Year on year, it expected to come in at 6.6. That's ex food and energy. It came in at 6.5. So you can see this visually, how it's rolling over. The base effects we discussed in recent podcast VideoCast should start to be felt in earnest in coming months. This simply means that prices had accelerated meaningfully in late spring of last year, and the comps will get easier and easier. This does not mean prices and wages will collapse overnight, but it is likely we're going to see the rate of change flatten aggressively in coming months, despite the Russia war, the China shutdowns, and their impact on commodities and the supply chain. God willing, we get a positive surprise on either front, and the impact could be more material and quicker. Interesting enough, as we look at the Russia-Ukraine war, I said when it first broke out that either it would get resolved with a negotiated settlement in relatively short order, in weeks or months versus years, or the market would just become desensitized to it, similar to Afghanistan. Obviously, the context is much different than the Afghanistan war, but we've actually seen that happen. The market is really not paying attention to that anymore, not looking for a positive surprise, and that's sometimes the instance that you get one. One key green shoot that came out of this report is that used car prices, which were a large contributor to CPI, are rolling over as expected. The administration's plan to release 1 million barrels a day for 6 months is starting to have a modest impact, as are China shutdowns on oil demand. Also contributing to some relief on oil prices, which should be seen in future reports. But you can see this big negative 3.8% print in used car and trucks. And then energy, this is all, we've discussed that in past weeks. Now, this week we did have the biggest build of crude inventories since October of 2021. So that is a very constructive thing to see. And moving right along to gentlemen prefer bonds. I married a blonde, and then she went back to her natural color, brunette, which is great. And now she's back to blonde. So gentlemen prefer gentle women, I think, is really what it comes down to. Hair color can go any which way. Anyway, this quote's attributed to gentlemen prefer bonds is attributed to Andrew Mellon. It's also kind of a reverse play because he preceded Marilyn Monroe. But okay, so he was an American banker, businessman, industrialist, philanthropist, art collector, politician, and he served as established a vast business empire before moving into politics. He served as United States Secretary of the Treasury from March 9th, 2021, the Roaring 20s, through February 12th, 1932, presiding over the boom years and then the crash of 1929. What is not often recounted regarding this quote, gentlemen prefer bonds, is that Mellon was not referring to all bonds, but rather tax-free bonds. He's widely remembered for seemingly favoring the wealthy over the middle and lower class by cutting taxes for high-income earners. However, the marginal tax rate at that time was 73% on the wealthy. So his rationality was that the wealthy were being taxed too heavily, and as a result, they were investing the bulk of their money into tax-free bonds. If he cut the tax rate, it would encourage high earners to move their savings from tax-exempt state and local municipal bonds to taxable higher yield industrial stocks investing in equity of the company for growth of the economy, growth of jobs, growth of capital formation. And I think that's what people miss when they try to tax capital, is that capital finances all of job growth and wage growth and innovation and everything that makes the standard of living go up over time. So once the tax rates for the wealthy were reduced, the tax revenues to the country actually increased materially, shocker, which was his plan all along. In last week's article, we showed this chart of long bonds as represented by the ETF TLT coming up on that long-term trend line. We proposed the idea that we may be approaching an inflection point where yields could stop accelerating upward and foreign bidders would step in at these levels to benefit from the relative yield play unfolding as the Fed stepped out of the market. The catalyst appears to have been the inflation prints this week. The 10-year yield finally appears to be retreating in recent sessions. We'll see if it persists. Now, moving right along to the B of A survey, want to drill down a little bit. Speaking of bonds, yesterday I put out this Bank of America Global Fund Manager survey. One of the key charts that stood out was positioning as it relates to bonds. Managers have been panicking out of bonds into commodities and cash. As we always say, when the boat gets too crowded on one side, it's time to take the other side. Not only are we getting close to a turn in bonds, but we may be coming up on a peak in commodities in the near term. This chart gives us clues. Managers are the most overweight commodities since February 2011. The peak was just 8 weeks later. See the blue vertical line below for February 2011. So this is February 2011. Managers in this survey were most overweight commodities in history at that point. Now they're most overweight again, April 22nd. That was the overbought signal on this Invesco DBC, which is a basket of commodities. And we're back to the future here. So whether we get another couple more months, as you can see, the biggest move was in the rearview mirror. The biggest move was in the rearview mirror. Here's the extreme sentiment and crowding that supports a similar reversal in coming months. You can see long only is the most crowded trade now, long oil and commodities. And which of the following assets will produce the best returns in 2022? Opinion follows trend. Everyone says oil. In 2020, no one said oil. So as was the case in 2011, the crowded positioning and euphoric outlook can persist a couple more months before rolling over. But why pick up the last few nickels in front of a steamroller? The time to, quote, crowd into energy was fall 2020. You can click on the article here when we were pounding the table, not today. We could revisit later in the year after a material pullback, but for now we sit on our hands and focus on brighter horizons. We look through the windshield to see where the puck may be going, not the rearview mirror where it has already gone. We are now out of most energy stocks except several natural gas names, which we believe are secular plays over the next few years. And we would add back oil on a material pullback in coming months if it shows up, and it would have to be material. Another chart that stood out from the BOA survey was overall sentiment. Pessimism is now parallel to 2008 levels, which is a generational buy opportunity. I do not think that such low levels of sentiment represent the same buy everything opportunity of late 2008, but I do think there are several sectors and stocks that are generational buy opportunities at these levels, namely China tech and biotech. Unquestionably, in our view, we've covered the theses behind those ad infinitum. As you can see above in the crowded trades, while everyone is crowding into the commodity trade, after it is long into the tooth, they are shorting what is down and likely ready to recover, i.e. China and bonds. Now, Alibaba, Abhishek Vaishnav, a reporter from Bloomberg, reached out for my thoughts on China stocks and Alibaba this week. Here's what I sent him. China began aggressive fiscal stimulus and monetary easing in November of last year. It will be felt in the economy and seen in the numbers on a lag basis, usually 6 to 9 months after commencement. The curveball this time is the zero COVID policy, and lockdowns have offset the benefits of easing in the short term. As for China tech, this is a temporary situation and will likely result in the big getting bigger and the small being able to unweather the short-term vicissitudes of a mercurial leadership posture. As this storm passes and COVID winds down in China, the biggest players will emerge with more share, more pricing power, and more strength. And that's going to be Alibaba and Tencent and JD. As it relates to the temporary price weakness of Alibaba, Tencent, JD, etc., I would liken it to a rental property. If you were renting out a house with a $500,000 fair market value for $4,000 a month and it went vacant for a couple of months and had no income, would you take the first offer to sell that came along for $350,000? That is what sellers of Alibaba and Tencent are doing at these prices. We have had a year of temporary impairment of earning power due to government crackdowns, zero COVID policy stance, and tight monetary and fiscal policy up until last November. The government has reversed course on easing, nearly completed the crackdown, and are licensing the COVID pill from Pfizer to produce generically. This pill, when available, will be the end of zero COVID. Owners of these unreplaceable franchises, Alibaba and Tencent, who are, quote, selling in the hole due to temporary headwinds, are no different than a landlord who sells their property at a 40% discount to fair value because it temporarily went vacant for a few months. It makes no sense, and it is a decision that will be deeply regretted a year out. Then, of course, when the reports Munger had sold half of his Alibaba position, the AMA questions and DMs just rolled in. I can't tell you how many of those. If you bought Alibaba, so while it was an unpleasant surprise, and we would have preferred to see Munger buying more shares versus selling, as we respect his investing acumen, here's the number one thing you need to know about the Daily Journal and the Munger sale. And here it is, quote, if you bought Alibaba because Charlie Munger bought Alibaba, you should sell your position. If you bought Alibaba because you did your own research and believed it's a generational buying opportunity at these levels in valuation, then the headline does not matter. As far as speculation on why the Daily Journal sold, it's a useless exercise. While insider buying in a stock can be a useful indicator, as people only buy stock for one reason, that is, they expect it to go up over time, they sell for a multitude of reasons that you will never know. The quantitative data over decades shows that insider buying can be indicative and insider selling has zero signal value. Now, as for my guess about what happened for entertainment purposes only, my take on the Daily Journal sale of half their Alibaba position this week, not this week, actually, it was in last quarter, which means they probably sold in the hole on that $75 down day. Either one, pressure from shareholders to sell in the hole, plus fear over margin debt used to finance the position and its impact on corporate liquidity, and particularly with all the recession noise coming out, the company was probably concerned they don't have a tremendous moat in their underlying business. Well, that's arguable because they have the lawsuit, the legal filing business, et cetera. But they probably didn't want to be in debt going into a potential recession next year, number one. And we also saw at the annual meeting, the Daily Journal meeting, if you watched it, some pushback in the questioning to Charlie during that meeting in the Q&A section. Best guess, Charlie said, quote, you can sell it if you want to, but then I'm stepping down as chairman. And he actually did step down as chairman. I don't know if it was coincident with the selling of half the stake or causal, but the timing is interesting, or it could just be that he's 99 years old. But leaving that aside, when people want out of a position, they don't sell 50%. They dump 100% of the position and take the loss, not 50%, which leads me to guess number two. They started converting their US ADS BABA shares to Hong Kong 9988 shares, as we did months ago, to offset the delisting risk. They are not required to report foreign holdings in their US filings, so you would never know if they owned Hong Kong shares unless they verbally disclosed it. So it's not certain that they've sold half their position. They might have converted half of their position, and we won't know unless they actually verbally give color on that. These two suggestions are for entertainment purposes only and have no bearing on our investment in Alibaba. The short-term headwinds of COVID shutdowns will ultimately be offset by the pig of parentheses of stimulus working through the python parentheses of the Chinese economy that began in October, November 2021. It's already showing up, but the pessimism is so thick that no one can see it yet, underline, capitalize, yet. So this week alone, we saw M2 money stock grew 9.7% year on year in China. New loans grew dramatically, expected to grow at 2.6 billion. It grew at 3.1 billion. Outstanding loan growth was up 11.4% year on year. And Chinese total social financing expected to come in at 3.7 versus the last print at 1.1 billion, actually came in at 4.6 billion, which is a 4x, fourfold increase over the last print. So if you think this stimulus is not going to work its way through the system in relatively short order, you're missing the boat on this. You're just caught up in all the noise of the short-term headwinds. Now, while the rest of the world is tightening policy, China is the only developed country that has been aggressively easing. As the shutdown ease, the impact of the policy will begin to show up meaningfully in the economy, as we are now approaching 6 months since inception of the policy pivot. Now on to the short-term view for the general market. This was unbelievable. The AAII sentiment survey result collapsed to 15.8% bullish from 24% last week. This is the most pessimistic sentiment in the history of the survey. Bearish sentiment jumped to 48.4% from 41.4%. Retail investors have never been more fearful in history. This is usually associated, anything in these levels is associated with bottoms. So I look at this as an aggressive contrary indicator, and that's how we're positioned. The CNN Fear and Greed Index ticks down from 48 to 46. Sentiment is still cautious in the overall market. And the National Association of Active Investment Managers, this was up to 83.41 from 79. We'll get the newer print this afternoon. My guess is that it'll be a bit lower. They got a little spooked, and they're still going to have to chase up to higher levels that they do when it runs away from them. So that's that for the general outlook and market commentary for this week. I'm going to take a few questions, but all of them were about Munger pretty much. So let's see. This was from JT about Munger. We already covered. This was about energy. So Ben asked about is energy going to go up or down, which he asks every single week. And the answer is it could go up before it goes down, but the juice is out of the trade. Would I short it? Absolutely not. Would I be a buyer if we get a meaningful trapdoor pull in coming months? Potentially, if it's pronounced as I think it may be, we would step in for over the next three to 5 years. If you're asking, should you short it? I think that's a dumb move. If you're asking, should you buy it because it's going higher? I think the big move was already made. We bought in 2020. We sold in Q1 and recent weeks of 2022. We took the big middle out of the trade. And if you want to catch the last few pennies, have at it. Matt Mitchell, that's on the Munger thing. Ben first name only is saying like, why did Chinese insiders sell before everyone else? Because that's China. I mean, it's not, they don't have the same legal system. They don't have the same anti-corruption policies that we have. They're trying to do it at the margins, but it's China. You know what you're getting into, which is why you don't see me in small cap or mid cap China stocks. I mean, I'm dealing with the ones where my bet is if Alibaba or Tencent go down in a material way, the system goes down. And we saw that when they announced 20% layoffs. The government relented and did an about face on their policy. They thought they could beat the hell out of these companies and it wouldn't impact their political power. But when you lay off 20% of the smartest people in the country that have an education, they get pissed off. And there are 100 families that control the government over there, and they're not happy with Xi Jinping right now. And they could take steps it won't be potentially before November, but they could take steps to remove him, and they will take steps to remove him if he does not do an about face and return the country back to the growth that they've experienced over the last few decades, where prosperity and the future was bright. So they've taken nascent steps. They'll probably be okay by November because of all the stimulus they're pumping into the system. And as these shutdowns release, things will start to boom. But look, they can take them out very, very quickly. Okay. Tom, I wanted to start by this is from Antonio. Antonio Albo. Tom, I wanted to start by thanking you for all your work. I know this takes a lot of time between your TV presentations, managing a fund and a family. I know you can't have a lot of time to do these videos week after week. So I'll thank you a second and third time. You're welcome, and you're welcome, and you're welcome. I've watched you since the beginning on YouTube, and you only get better. My question is, what are your thoughts on buying puts on PennyMac? Loan origination and refinancing has been down significantly and expected to continue. Most names have already dropped, but this one has held up. better compared to the others. I'm looking at $50 puts for January 2024 for $11. Thank you again. I don't like this trade, Antonio. I understand your reasoning, but I think a lot of that's priced in. And you have to consider this is not a normal cycle. This is 72 million millennials at age 30. So as rates go up, prices will probably stop going up so aggressively in the next 12 to 18 months. That's basically what the Fed's trying to do is get prices to stop going up on housing. And I think they'll succeed. The refinance business is going to be impaired. There's no question about that. But I think the origination business, if you look back to 2003 to 2006, they had already done multiple hikes in 2003, 2004, and the game was just getting started in terms of origination volume. And I do believe that the origination volume is going to far exceed even the most aggressive estimates from the sell side. I think the volume is going to be monstrous for the next 4 years with 72 million millennials, bigger than the baby boomers at average age 31, starting housing and family formation. This thing is the pig in the python. Demographics have always drove the demand bus, and this time will be no different. So I would not be a short seller of Penny Mac. Would I be stepping in with two hands to buy it? No. But I do want exposure to the originators here because I think this is going to be a 5-year trend. Ben asked more about energy. I've answered the energy thing not only this week, but multiple times in previous weeks. REITs have been going up despite interest rates going up. What are your latest thoughts on REITs? Well, I said about a month ago, we had the hike in March. So everyone was crowding into cyclicals, and I said, here's the quantitative data for the last 3 decades. The quantitative data shows that 6 months after the first rate hike of a tightening cycle, the top 2 performing sectors, counterintuitively, are REITs is number 1, and tech is number 2, and no one was positioned for that. So, REITs, you got the dip on their interest rate fears. Now it's holding strong. I mean, I think they're up. So I don't chase things up. That's just me. I chase things when they are out of favor and no one wants them. So, part of the REIT trade. So yeah, they're not quite back at new highs. They're probably okay here, but that is the data. They tend to outperform in the 6 months after the first hike. Real estate as a hedge, but there's so many better things to do. Why? It's up 15% off of its interest rate fear high. So it dropped from 16 to 96, call it 20% into the hike. It was down 20% into the first rate hike. It's now up 15% after the first rate hike. So yeah, it could push higher, and it probably will. But why are you buying things? You do whatever you want to do. This is opinion, not advice. But buy things when no one wants them, not after they're already, had relatively decent sized moves and you're just chasing momentum. It's my view. Now, if you're a day trader, maybe your philosophy differs, but for me, I like to buy things when they're on sale, when no one wants it, and I'm willing to wait. Time is my hedge if I know the quality of the asset that I'm buying. So look, with that said, this has been a wonderful call. Thanks, guys. We'll be back next week in Connecticut and New York. Back to normal, probably a bit longer VideoCast podcast, but I think we crammed a lot of really valuable and timely information in a short period of time. Thanks for listening in. As always, until next week, make it a great one. Bye for now.